afternoon. Welcome to Halftime Report. I am Reema Tendulkar. With me is Nigel D'Souza, and this mid-cap underperformance is continuing for yet another day. The mid-cap index is down about 1.5%. Very weak advanced decline. We've got nearly 1,500 stocks in the red, and the streak of mid-cap underperformance has taken the index down about 8.5% since the start of the year. Even the frontliners are fairly lackluster, so you've got the Nifty down about 50-odd points. The Sensex is down about 125 points. It's pretty much a red Monday wherever you look at it.
Absolutely, Reema. Just take a look at some of those metal stocks, the way they're selling off. Hindalco is down close to around 4%. You have Nalco that's down nearly around 8 to 9%. Last full week, we were hoping that there will be some shutdowns and curtailment of production all across the globe, and that's why that will support prices. Now it seems that the street is definitely reacting more to global growth concerns. That, if that's going to happen, then in fact all these base metals, if you notice, base metals are selling off more than the ferrous stocks. Hindalco, you have Nalco as well as under some pressure. Tata Steel, of course, reacting to its numbers, but that's down only around 0.5% approximately. Let's start off the show though with all the top stories as we speak at this hour. The market trends lower, the Nifty slips below the 10,900 mark. The key indices is under pressure from heavyweight stocks like Reliance Industries. ID stocks buck the trend.
The mid-cap index continues its underperformance. Apollo Hospitals is the big drag despite good numbers. Nalco, PC Jewelers react to earnings miss. Divan Housing too bears down.
And the Mahindra & Mahindra stock takes a hit after the company cuts its FY19 tractor industry growth guidance to 10% from around 12 to 14% earlier. UBS slashes the target price to 880 rupees on rising competitive pressure in the UV segment.
Dr. Reddy's is the big index drag after the pharma major received 11 observations for the Bachupalli facility in Hyderabad. The unit supplies 45% of the total US sales.
And metals pack is under pressure on fears of global growth slowdown. Tata Steel extends cuts after India business disappoints in the past quarter.
Let's get cracking to what's moving and shaking beneath the surface. This is our Movers and Shakers segment with our entire team. It's Dr. Reddy's, which is the top index loser, down 6.5%. Lupin 2 has got some US FDA blues this Monday morning.
Yes, absolutely. Well, I'll start with Dr. Reddy's, which is in focus. This is after their Bachupalli unit in Hyderabad, which is a formulation plant, received 11 observations from the US FDA. Now, remember that this is the second instance that Dr. Reddy's has received the same number of observations just in the past couple of years for this particular unit. Back in April of 2017, they had received 11 observations for this unit. And however, that got resolved successfully by December of 2017. They had received an EIR as well, or an establishment inspection report. However, the street seems to be a bit uncertain now, simply because you don't know what the nature of these observations are. Remember that the quality and the nature of the observations matter more than the number, but the fact that there are a large number of observations, that obviously has spooked the street. Remember, Bachupalli is an important unit for Dr. Reddy's. Around 45% of their US sales and around 15 of their total of 100 filings comes in from this particular unit. For Lupin, similar story there. Their Goa facility, which is their most important unit when it comes to their US sales, plus under warning letter since November 2017, was re-inspected by the US FDA, received 2 observations. We don't know the nature of the observations, but the fact that there are lesser number of observations always gives hope. But remember that I just want to cite an example that recently Aurobindo's Unit 4, which is the injectable plant, also received 2 observations, but the total number of pages for that Form 483 were around 12 in number, with the first observation running into 11 pages. So that doesn't, the number of observations doesn't always give you certainty that the quality would be okay and benign as well.
Okay, all right, Ekta, thanks so much for that. But Mahindra & Mahindra, well, came out with its set of numbers in the second half of trade on Friday. The numbers didn't look good, but they cut guidance after that as well. Sonia's with us to run us through all those details. Sonia?
Mahindra & Mahindra is under a lot of pressure because they've cut the industry tractor guidance to 10% versus 12 to 14% earlier. Remember, earlier on they had said last quarter that they will manage to meet only the lower end of the band of 12 to 14%, but now they've scaled it down further. Not just that, even in the passenger vehicle segment, they've said that, they'll only manage to do about 5% growth or so. Now, a lot of brokerages have cut their target price on the stock. UBS has cut it to 880 versus 950. They say that there there are a lot of competitive pressures in the utility vehicle space. They expect the auto volumes to decline by 10% in FY21 because of the transition that many of these companies have to make to the new BS6 norms. Remember, Escorts, the other tractor maker, also cut their own guidance, after the third quarter numbers. They reduced the tractor industry growth to 10 to 12% versus 12 to 15% earlier. They said in Q4, the industry will grow only 3 to 5%. As I said, a lot of brokerages have cut their estimates on Mahindra & Mahindra. Two more. Credit Suisse has cut their target price to 890 from 1020 earlier. They said that Q4 will be another soft quarter for the company in terms of margins. Deutsche Bank has cut the target to 815 from 850 earlier. They expect a slight improvement in FY20 auto margins, but they've lowered the FY19 to 21 tractor volume forecast by 3 to 4%. So not looking good for M&M in terms of forward projections. Back to you.
Absolutely. Let's hear out what the management, Pawan Goenka, the MD of M&M, had to say.
Given how the month of December has gone and given how the month of January has gone, and January has been flat for the industry, our current estimate is that Q4 will be flat because last year was a high base. And on that basis, we expect to be at about 10% for the industry growth for the year. So basically, that's where we are. If the Q4 surprises us and goes to, let's say, 5% growth, then we might be 11%. But that's about the best that we can expect right now.
Well, amidst all the doom and gloom, there are a couple of stocks that are doing well and reacting to their numbers. Sun TV, well, the numbers look good on all parameters, valuation-wise as well. The stock is reasonably attractive. It's up 8% in such a wobbly market. Nupur, fill us in with all those details on Sun TV's numbers. How good was good?
The numbers were really good, Nigel, above the street expectations. Revenue grew by 32%. We were working with a number of 19%. Revenue growth was led by ad revenues, which grew by 13%, above the poll of 9 to 11%, while subscription revenue also grew by 24%, ahead of the expectation of 20 to 22%. Profit grew by 32%, but it is to be noted that other income also went up by 75%. Over the con call, management guided for double-digit ad revenue and 20% subscription revenues in FY20. But remember, the loss of market share in Tamil Nadu from over 60% just a year ago to 39% in the last quarter remains a big overhang on the company, which led to the sharp decline in the price in last 1 year by almost 43%. But currently, the stock is trading at 14 times FY20 expected earnings, which is 30% discount to the 5-year average. Motilal maintains buy rating with a target price of 750 per share, and Citi also have a buy call with a target price of 800 per share. But with the good Q3 numbers and the management positive guidance, and the stock trades at 14 times, it is up almost 9% in today's trade. Back to you.
Thanks, Nupur, for that. Let me add Kotak as well on Sun TV, where they say even as the valuations are attractive, we would wait for an improvement in their core market, which is Tamil Nadu, and effective investments in digital to safeguard the future before they turn constructive on Sun TV. But they believe that the stock offered their 10% upside given the recent correction, and you're seeing that today. Let's move on. Dilip Bilkon, the Q3 numbers were higher than street estimates. Earlier today, we spoke to Devendra Jain, the CEO of the company, who says that they are looking at a 20 to 24% growth to wrap up F519. Listen in.
There is not much scale down due to some delays in our appointed dates in our HAM projects. That's why the guidance is reducing due to the bankers' problem in last 3-4 months and due to some land acquisition problem. But now things are on track. So we are not reducing much. Only we are reducing by 300 to 400 crores. And then we will again maintain in the Q1 20. And even after that, we are maintaining more than 20 to 24% growth in whole year.
Okay, all right. Let's get in Sonal. Then she's going to tell us about all the numbers that have come in. Sonal, over to you.
Thanks a lot for that, Nigel. And I have a long list starting with NALCO, where the margins, they missed the estimates. That is because of lower alumina EBIT and also losses in aluminum. So basically, the margins, they came in at around 18.9% versus 14.36% on a YOY basis. This compares with an estimate of around 22.4%. And that is something that the street is not liking. Additionally, effective tax rate was higher this time around, slowdown which dented profits. So profitability, that went down by around 58 odd percent. But do remember the base year, it had an exceptional gain of around 801 crore rupees. So optically, the base year profits are looking very, very high. Moving on, PC Jewelers, the stock is sulking in trade today. The numbers did not look good at all. The revenue declined by 19 odd percent. The profitability also declined by around 15 odd percent. And this was led by the exports market, which was down around 65% at 300 crore rupees. KRBL also looked very weak in trade today. The operating profit margins have declined by around 200 basis points. The profits are also down on a YOY basis. Lastly, Thyrocare, the numbers were very weak. The revenue was up around 15%, but there was an expectation of 17% growth in revenues. Margins have not only declined on a YOY basis, but sequentially also we are seeing weakness. Let's also listen in to what the management had to say.
Diagnostic FY19 will be poor. Top line may not grow more than 15%. EBITDA will be more or less 10-15% only will be the additional growth. Only in 2020 I will be back with my growth.
Okay, so many misses this time around. We are expecting numbers from Motherson Sumi anytime now. The expectation is that the revenue growth will be about 15%, but there will be some pressure in margins on account of a slowdown in the standalone business and the SMR business. We've got the bottom line, and that seems to be in line with estimates, so 389 crore. So that's in line with our expectations. So right now, at least going by one number that we have, the stock is reacting positively. The consolidated net profit has come in at 389 crore. I guess that would be a growth of roughly about 5% thereabout on a year-on-year basis. The top line is actually lower than estimates at 16,473 crore. So compared to our expectation of 16,600, it's lower by about 130 odd crore. So a bit of a miss on the top line, a bit of a beat on the margin front. But again, the deviation is not too much, just about 100 crore miss on the top line and 8-9 crore beat on the bottom line. I guess, Sonia, you would say largely in line. We will wait the margin performance because that's where you are expecting the pressure to come through.
Yes, at least the prima facie numbers look like they are largely in line with estimates. And I think the street will like that because, you know, the stock has fallen a lot. It's fallen almost 40% over the past 6 months. The fact that there is no major negative surprise, at least in the prima facie numbers, I think is something that the street will definitely like. Now, just to give you the percentage growth, the profit growth we expected was about 3.5%. It's come in at a 6.5% profit growth, so it is definitely better than street expectations. On the top line, 16,473 compares to about 14,397. So that is about a growth of, 1 second. Yeah, so that's a growth of almost 15% on the top line. So top line growth largely in line with expectations, profit growth better than expectations. So I think, you know, prima facie the numbers are good. Just looking forward to what the breakup is, because SMR is really the place where we did see a lot of the startup costs hit the numbers last time around, the margins as well. I'm just going to calculate the margins, just give me a minute, and then we can ascertain how the operational performance has been. But prima facie, the top line and bottom line numbers is no negative surprise. So I think that's something that the street likes.
Actually, the standalone numbers on the top line are not looking very good. So the standalone revenues have come down by 3.5%. I'm talking purely about the top line. The SMR revenues are up about 9.5-10%. S&P revenues have gone up by 10%. You were adding some more color?
No, I just, you know, waiting by for the margins. I think our ticker team has calculated it's come at around 8.46. I think they'll just recheck that number as well, you know, just to get some clarity on that one. So we'll keep an eye out on that. For the time being, in fact, it appears that, you know, the numbers are more or less in line, both the top line as well as the bottom line as well. We'll wait by soon. I'll be calculating those numbers for us. For the time being,
the core EBITDA, I think, is coming at 1,393 crores. If that is correct, then it's better than what the street was estimating. 8.4% margins, Nigel, are better than estimated. Remember, it's not such a big fall. In fact, last time it was 8.6%, the margin that they saw in the previous quarter. And this time it's coming at 8.4%, so it's just a 20 basis points fall. This will be taken with both hands by the street. What this indicates is that perhaps the startup costs have been lower. I'm just going to wait by for the press release. But remember, the startup costs last quarter had risen to 20 million euros, and the management told us that it's just a 1-2 quarter, you know, hit that they're going to get because of startup costs. possibly the startup costs have gone down, startup of the new plants, I mean, and that has resulted in better than expected margins. So this is definitely something that the street likes. The fact that the EBITDA performance, it's almost 8 to 10% growth that we've seen on the EBITDA, and the margins at 8.4%. It's still a fall year on year, but quarter on quarter, if you see, it's largely stable, you'd have to say, and that's something that the street will definitely like, because as I said, that the stock has fallen considerably. So, you know, the fact that there's no major negative surprise, in fact, it's a positive surprise. The margins are better than expected. If this is the margin picture, that's something that the street will definitely like.
Okay, that's Madison Sumi for you. So largely in line with estimates, a bit of a beat on the top line. Sonia, any thoughts on the top line performance? You know, the standalone business is actually degrown. If I look at the revenue performance, it's come down by 3.5%. Is that lower than what the street was anticipating?
Yes, it is lower than the street expectations. The expectation was a growth of around 4%. But, you know, I'm just going to look at the breakup of the other businesses. The SMP business has seen a revenue growth of 20%. The expectation was that it would grow about 12 to 15 odd %. Of course, there's a Radel acquisition as well that has gotten factored into it this time around. But a 20% growth on the SMP business is something that the street will definitely like. But I take your point, you know, the fall in the standalone business is something that's worse than what the street was expecting. But consolidated numbers look fine, Rima, and the fact that, you know, they are growing in the SMP business, some of their verticals are growing and doing better, is, I think, something that the street will definitely like. I'm also going to be very interested in what the SMR business has seen in terms of growth. Just give me a minute.
That's about a 9.6% revenue growth for SMR. Okay. And SMP, as you said, is up 20% on a year-on-year basis.
Okay. So SMR is a 9.6% growth that we've seen. I'm also looking at what the EBITDA number is for SMR in euro terms. From the press release I'm reading out, it's a 2% revenue growth that they're talking about at 398 million euros, and the EBITDA has remained absolutely flat. So there is no real fall in the EBITDA for the SMR business. And the SMP business, as we said, it's an 11% revenue growth. This is from the press release, ex of the Radel acquisition, and a 4% growth on the EBITDA front. PKC as well has grown 8% in revenue terms and 47% in EBITDA, so no problems there as far as PKC is concerned. And last quarter, you know, the debt was a bit of a concern for the company. So I'm just going to try and fish out what the debt situation is. Okay, wait. It says that the net debt for the company as on 31st March has...
I think it's come in 9,705 crore, which is much lower than 11,300 crore.
You know, if you look at the finance cost itself...
It's actually fallen a lot quarter on quarter to from 11,300 crores consolidated numbers. Even standalone debt has fallen quite a bit actually, 9,705.
Yeah, you'll actually get a sense in the finance cost, because the finance cost has come in at around 88 crores. That compares on a sequential basis with 130 crores. So the very fact that the finance costs had come down, that's telling you that in fact, you know, there was some kind of debt reduction, and now the stock is reacting. Now the stock has moved to the high point of the day because the EBITDA number is better. There is some debt reduction as well, and the top line is more or less in line. And as Sonia has been telling us, that the stock has fallen considerably. So now the stock has moved to the high point of the day. So quite a few tick marks, and I think the street likes that, at least as of the numbers that we have.
And you know, last time the stock had corrected a lot because of the debt. The debt had risen. This time around, almost 1,600 crore fall in debt quarter on quarter is something that the street will definitely take with both hands. So both on the operational front, numbers are better than expected. EBITDA margin is much better than expected. Largely flat on a quarter on quarter basis, so no major deterioration. And even on the debt front, the fact that their balance sheet is looking a bit stronger than before is something that the street will definitely like.
All right, thanks so much for that, Sonia. The stock has moved now to the high point of the day. Was waiting for clarity in terms of is there some kind of a one-off, but for the time being it appears that the operational performance is better than what we're working with, and debt reduction, that's something that was worrying investors the last time around. This time around it's come down. The finance cost itself is telling you that there's quite a big debt reduction out there. Let's do one thing, slip into a short break. You come back, we'll get chatting with the management of IEX. Stay with us.